An employee who earns $25 per hour can easily cost a service business $40 per productive hour, and that still is not the hourly rate the customer must pay. Wages are only one layer. Payroll taxes, workers' compensation, paid time off, training, uniforms, non-billable time, overhead, and profit all sit above the number printed on the paycheck. If you quote labor by multiplying wage by hours, the business can stay busy while losing money. In this video, we will calculate a true hourly labor rate in 3 stages: loaded employee cost, cost per productive hour, and the customer-facing billing rate required to cover overhead and leave a target margin. Start with an employee earning $25 per clock hour. The first adjustment is statutory and benefit burden. Assume employer payroll. Taxes add 9%. Workers' compensation adds 4%. Paid time off adds 7%. Health, retirement, uniforms, training, and other employee costs add 10%. Together, those items create a 30% labor burden. Multiply the $25 wage by 1.3. Loaded cost becomes $32.50 for each paid hour. That calculation is useful, but it is still incomplete. Customers do not pay for every hour on the payroll. An employee may be paid for 2,080 hours in a year. Subtract holidays, vacation, sick time, training, safety meetings, vehicle loading, callbacks, shop cleanup, and other non-billable activity. Suppose only 1,560 hours can realistically be sold to customers. That is a 75% utilization rate. The business still pays the employee for all 2,080 hours. At $32.50 per paid hour, annual loaded labor cost is $67,600. Divide that annual cost by 1,560 productive hours. The true labor cost becomes approximately $43.33 for every hour that can be sold. This is the utilization trap. The wage is $25. Loaded paid hour cost is $32.50. But cost per productive hour is more than $43. Ignoring utilization understates the cost by over $10 for every hour quoted. Now include overhead. Assume the business has $18,000 per month of operating overhead. This includes insurance, advertising, software, phones, office support, rent or storage, licenses, accounting, vehicle-related fixed costs, and the owner's non-production work. The company has 3 technicians, and each can sell 1,560 hours per year. Together, they produce 4,680 sellable hours. Annual overhead is $216,000. Divide that by 4,680 productive hours. Overhead adds approximately $46.15 to each sellable hour. Add productive labor cost and allocated overhead. $43.33 plus $46.15 equals $89.48 of operating cost for each customer-facing labor hour. That number is the hourly break-even cost before percentage fees, warranty, risk, and profit. If the business charges $90 per hour, it is not earning a healthy margin. It is approximately breaking even before card processing and ordinary estimating error. To calculate a customer-facing rate, solve backward from the target margin. Assume a 30% target margin and a 2.9% processing fee. Divide $89.48 by 1 minus 0.3 minus 0.029. The required rate is approximately $133.35 per billable hour. At that price, the processing fee is about $3.87. Operating cost is $89.48. Estimated profit is $40. That is 30% of the selling price. The billing rate is more than 5 times the employee's wage. That can look surprising until every layer is visible. The customer is not buying one isolated wage hour. The price supports payroll, burden, paid non-production time, insurance, equipment, scheduling, customer service, marketing, management, compliance, and the capacity to return if something goes wrong. This does not mean every company should charge $133 per hour. It means the rate must be calculated from that company's real cost, structure, and productive capacity. There are 5 assumptions that most often distort this calculation. First, utilization is set too high. No field employee bills 8 hours during every 8-hour shift. Travel, setup, meetings, weather, cancellations, and administration consume capacity. Second, the owner's time disappears. Quoting, hiring, scheduling, purchasing, bookkeeping, and customer follow-up are real operating costs even when the owner does not run payroll for those hours. Third, overhead is divided by total payroll hours instead of realistic sellable hours. That spreads the cost across hours customers cannot buy and creates an artificially low billing rate. Fourth, callbacks and warranty work are treated as unusual. If they occur regularly, their expected cost belongs in the assumptions. Fifth, the same labor rate is used for every service. Some work requires more equipment, risk, certification, supervision, or non-billable preparation. The hourly rate is also not necessarily the customer's final pricing format. A business can use this internal rate to build flat-rate prices. If a service requires 2 productive hours, multiply the internal billing rate by 2, then add materials, equipment, travel, disposal, permits, and any job-specific costs. The customer can receive a clear fixed price while the company still protects every labor hour underneath it. Review the calculation quarterly or whenever payroll, insurance, staffing, advertising, or production capacity changes. Track paid hours, sellable hours, actual job duration, callbacks, and overtime. The quality of the rate depends on the quality of the records. Here is the full process. Start with the base wage. Add employer taxes, workers' compensation, benefits, paid time off, training, and other labor burden. Convert annual loaded cost into cost per productive hour. Allocate overhead across realistic sellable hours. Include percentage fees. Then solve for the rate that leaves the target margin. ServiceQuoteLab estimating tools separate these layers so an owner can replace every assumption with actual payroll, overhead, utilization, fees, and margin. The complete collection is linked in the description. This video is educational business planning content. Before using the example, replace every number with your actual costs, taxes, fees, insurance, productivity, and operating conditions. No billing rate or profit is guaranteed. Subscribe for practical service business pricing lessons. Next, we will expose the overhead costs that quietly disappear from otherwise professional quotes.